everybody. Welcome to another episode here of Cressy's Ontario Landlord Series, where today we're going to be discussing putting together and everything to do with a joint venture. What is a joint venture, you ask, otherwise known as a JV? Well, simply put, it's a business arrangement where two or more companies or people collaborate to take on a certain project. It involves the sharing of resources, risks, and profits, which allows companies to leverage each other's strength and expertise for mutual benefit. Joint ventures are a common structure used for those investing in developing real estate, which is why today we're speaking with my friend and colleague, Mr. Shawn Quigg, a lawyer from Cardinal Law, where his firm specializes in helping investors, landlords, and entrepreneurs with their estate planning, real estate transactions, and of course, joint ventures. Shawn, how you doing today?
Kevin, thank you so much for having me on. And I hope a joint venture involves some profit. Otherwise, what's the point?
Right? That's why we're all doing this. That's why we are investors in real estate, is to turn a profit. Um, so joint ventures, I guess I'm going to share with you my four things that I think are key to putting together a joint venture contract, and then we'll let you take over as the professional to put it all through and explain it out there to everybody, and maybe break down the four things that I'm saying here as well. But simply put, I think this is definitely something that, folks, it has to be a written agreement where you both need to have separate legal advice, right? Like, let's get independent here. Let's not talk about it. The other one I think is an exit strategy or multiple exit strategies. Having a plan for cash calls in case something isn't exactly going according to plan, to making sure that you have that ability to get more funds if needed. And then lastly, the one that no one ever wants to think about, same reason why you're going to get mad at me when I say this, I don't even have a will yet. I don't want to think about death. No one wants to think about death. And but you need to have some kind of plan in case you're doing something like this and something goes sideways, or even needing an immediate exit in case of a divorce or another financial situation where that asset needs to be sold. So those are my four basic things. Sean, what do you think about those?
It's almost like you've been to law school, Kevin. Like those are pretty good.
I watched a lot of Matlock as a kid.
Well, when I talk to anyone really about joint ventures, try and position them as they have a life cycle, right? They're born when someone finds an off-market deal or an on-market deal, and maybe they have the expertise but not the money, or maybe they're a person with money but they don't have the expertise. And like you said off the top, a joint venture is really a collaboration in the end. It's the combination of skills and resources to generate profit. And profit can look all sorts of different ways, right? It can be monthly cash flow, it can be a flip, right? The profits generated on a flip. It could be long-term appreciation, it could be mortgage pay down. If we get into rent to own, it can be all sorts of different buckets. But I like the four that you identify because those are big milestones within the life cycle of a joint venture, right? And you started off with a written contract. So if we go all the way back to law school, which for me was several years ago, one of the first things we learned was that a contract is a meeting of the minds, right? There's a Latin term, or that doesn't matter, but a meeting of the minds is what forms a contract. And you might think, okay, well, that's a little simple, and you're right, it is. So we can get a little more complex. There are three components that make up a contract, right? You must have all three of these things for a contract to be a valid contract. One is an offer, right? So if you and I are doing a deal, I'm going to say, hey, I found this deal. I need your money, Kevin, because I hear you got so much money. I got the skill set. I'm going to offer you to come into this deal, right? That's the offer. The second component required for a contract is acceptance. So, Kevin, you got to put up your hand and say, yeah, I'm in. And third, there must be consideration that flows both ways. Now, consideration is in the proverbial eye of the beholder, right? The courts are not going to step in and say what constitutes consideration, as long as there is something. This comes from a very long line of cases all the way back to England in a case infamously known as the Peppercorn case, where a judge had to rule about whether a contract was valid, and in this case, in his judgment, he said something to the effect of even a peppercorn would be valid consideration, which stands for the proposition that literally anything can be consideration as long as you and I consider a consideration. So in this case, I'm saying, hey, Kevin, you're going to put in your 100 grand. We're going to buy this property together. You're going to get half the cash flow and you're going to get half the profits when we sell. What do you think?
I'm in. There's my hand ring.
Great. All right. We have a contract. So those are the three components. And then we get into what does that contract look like? So you and I just formed a contract. Now we're going to mutually release it after. But but what what matters here is what is the evidence of the contract? Evidence comes to provability, right? Evidence speaks to whether or not you can prove you had a contract. The thing is, you can have a contract just by talking. You can have an oral contract. That doesn't make it smart. Just because you can do something doesn't mean you should. Having a verbal contract is no bueno for joint ventures. I can tell you, back in 21 and 22, when real estate was all the rage and everything was flying off the shelf and we were having 15% appreciation a month, I couldn't draft JV agreements fast enough. But now that the other shoe has dropped, uh, it's how quickly can I get out of them? And you'd be surprised how many people show up with a contract they drafted themselves, no contract at all, or uh, a precedent that they pulled from a Facebook group that they inserted some names in, didn't bother reading, everyone signed, and off they went. And I'm here to tell you that friends don't let friends draft their own contracts. You mentioned something, independent legal advice, whether it's me or another lawyer that works with real estate investors. If you're considering entering into a joint venture agreement, you you should not think about doing it until you get some independent legal advice. What that independent legal advice is going to do is help you understand the pros and cons of this deal. Now, good lawyers aren't here to kill deals, right? Bad lawyers kill deals because they don't want to take the time to understand, or they don't want to take the risk of advising you to do something and then it not working out and you suing them. That's the lowdown. That's how a lot of traditional lawyers work. What a good lawyer does is they tell you, well, here are the pros and here are the risks, and here's how you mitigate them. Are you willing to accept these risks? One thing I tell people, Kevin, I'm pretty sure you and I've talked about this. If you want to make money, you have to take risk. Interest rate is a reflection of risk taken, right? Rate of return is a reflection of risk. So you can't put in your 100 grand and not take the risk, some risk of losing it. The way we sort of capture how we're going to spread out the pros and cons, the risks, is by writing it down and negotiating the terms. Now you might say, "Well, I want a cap of my loss of 75,000. So if so only 75 of my capital is at risk and I want you, Sean, to cover 25." And I might say, "No." Or I might say, "Sure." Right? Those are the sorts of things that good independent legal advice will help you understand and capture and think to put into the document.
I think too, a lot of it, like, sorry, it's guidance, right? It's here are your options. Here's what's going to happen to you, just so that you're aware. Like you said, pros and cons. Let's evaluate everything and then be able to take a good look at it. And at the end of the day, it's always that investor's, that landlord's, that person's decision. As long as they're having the proper guidance and advice to cover every situation or scenario, not just, hey, it looks like option A is there, so you better do option A. That's what it is, option A.
That's right. Yeah, a good lawyer helps you understand what the writing means. And a super good lawyer drafts in a way that makes sense to the everyday person, right? It's easy for lawyers to get caught up in legalese and lawyer language because we understand it, we were trained on it, but the regular investor, they don't care about any of that. They want to be able to just read it, understand it. It should be in plain language, and let's move on with our day. So that's a really excellent point to start on. So, and that's the birth of the life cycle of a JV, right? The deal, then the contract, right? What was your second
Second
point?
one was exit strategy, right? Like, how are
Exit
we gonna
strategy.
get out of this? What are our ways out, you know? Hopefully, we have the option A, that's the great one where we're all gonna make money, but what is our option B, C, etcetera, right? We have to know how we're gonna get out.
Well, here's the thing I learned early on. in business and in law is that if you're starting a venture of any kind, then you need to plan for the exit because it's not that smart to start a venture to think you're going to own it for your whole life. That could be a very poor use of capital and time. And so you're absolutely right. You do want to plan an exit strategy. And the exit starts with what is our primary objective? Is this a burr? Is this a flip? What is this? Right. So is this a just a if you're an institutional investor, you're probably buying premium product and you're earning a 5% cap and or maybe 3% cap, whatever it might be, and you're paying your investors and everything's fine, right? So you're not necessarily buying value add buildings. But most people at our level are buying value add stuff because they need to get their capital in, refinance it out, and move on to the next one. So in the long term hold play, then you build your exit backwards. When do we want to exit? Now, traditionally, we see 5-year post stabilization. That's a typical exit with options to extend, right? If the good times are rolling, why not keep them going, right? So, working backwards on your exit strategy is so important. And this actually goes back to the importance of drafting, right? So, we talk about the options with exit strategy, and exit can look very good, right? Like, okay, our 5 years is up. I've enjoyed the ride, but I'm going to get off now. And that's fine. And if it's drafted correctly, it will give each party the option to do that, right? If that's what you want. Exits can look not so good, right? Your fourth point is about sudden exits, and we'll touch on that in a minute, but you do need to create a roadmap for those as well. If you've got a flip, well, then maybe your exit is not based on time, but it's based on milestones or events, like finishing the project, right? I don't know if you've done many flips, Kevin, but or really, any real estate project, there ever been a single one that's gone perfectly, that's gone on time, on budget, with absolutely no issues whatsoever. That's never occurred. So to tie a flip exit to a time makes no sense because it doesn't build in for the possibility of something else happening, right? Like my second flip rather, we got in there, opened up the walls, had to replace all the electrical and plumbing. That was not in the project plan. So, that added a couple of weeks and a bunch of money. So luckily, our joint venture agreement was not based on time. It was based on events. So no one got in breach.
The other one I was talking about was actually kind of just what you're talking about there. Something's going to go wrong, and now you're going to need a cash call, right? More time, more money. We only had
Mhm.
X in the budget, and now we need to pull another 10K, five from you, five from me, right? Whatever that may
Yeah.
be.
Cash calls are the biggest source of conflict between joint venture partners. And it's simply because generally the expectation is if I'm the money partner, I'm putting in my 100 grand or whatever it is. That's it. And what I tell my active partner clients is prepare your money people for worse, way worse than this. Prepare them like they need to prepare to put in double because no project ever goes perfect. And if you set the tone early that you are full on expecting the capex or the reno costs to be way more, 40, 50% more, and your project still pencils out, then when it happens, your money partner is not nearly as ticked off. But I can tell you, if you set the expectation, oh, it's 100 grand, no way it's anymore, because that's what you need to sell the deal. And then you need 50 grand 3 weeks later, doesn't go
Yeah,
well.
and
So planning for cash calls is not just the terms of the contract, it's the relationship. And, sometimes I get asked about what are the things I should be thinking about before entering into a deal. And I tell people more important than the contract is the relationship you have with your partner. Set the tone early, set expectations, both good and bad. Good expectations in terms of here's what you can expect from me, and sort of boundary expectations of listen, we're going to speak once a month unless operations require us to speak more. But no phone calls at 3 a.m. There's no daily anything, right? So you've got to set expectations. Otherwise, you're going to get bogged down. So, to your point on cash calls, very important to get the language right and have those conversations early, and then set expectations that there likely will be a cash call.
You just made another point that I think is key to all this as well. And you talked about communication, how often, when, etc. I think communication, like any relationship, is huge, right? Business, anything, you have to have both sides that are understanding of one another and what's going on. So if one person thinks you're talking every week and one person thinks you're talking every month, those 3 weeks are going to go
That's right.
by and that person's going to be sweating or they're going to be calling you. And no, communication is huge. And then just
Yeah. And setting expectations and then meeting them, right? Do what you say you're going to do. That's the number one way to keep your partners happy.
the the other thing that just to touch on everything, obviously, when you're talking about the cash calls and expectations and what we're going to do, any of these projects, anything that's done on any scale, nobody wins if completion doesn't happen. You have to get to the end. You have to get through
Mhm.
it. So be prepared for those hiccups, those bumps, but you got to be able to get to the end, or else it does not win for anyone. That's for sure.
Yeah, it would just everyone just loses. Just a bunch of losing. And there's been a lot of that recently. The last 2 years has been a real grind. If you're a landlord or if you're an investor out there, you know what I'm talking about.
Yeah, no, and I'll share this. It's a little off topic, but just because we're talking about losing money, the speculatory investor, the pre-construction investor in the GTA, is set to lose $14.2 billion or something like that. I heard the other day with all the pre-construction from all that money. What's happened the last 2 years?
That
It's crazy, eh?
is so much money. Yeah. Wow. So your last point was about sudden exits.
Yeah, yeah, yeah.
Sudden exits can have a lot of different looks, and you sort of have to classify them. Some are involuntary, right? Death, incapacitation. Those have a different class. And generally, when I'm drafting, I advise people, in those circumstances, might be better to treat those nicer than, say, voluntary early exits. Because if someone dies or suffers a brain injury and they can't participate anymore, that's not it's not their fault. It might have been an accident. It doesn't really matter, but they didn't actually do something in respect of the actual venture itself that caused the exit. But there are other types of early exits that do need to be sort of treated more firmly, and especially if you're an active partner. Now, in all of my time doing this, most, the vast majority of people that want to exit early are money partners, right? And of course, we're talking about the traditional joint venture of a skilled person and a money person, right? But the vast majority of people that want to leave early are money people, which puts the active partner in a really difficult spot because their payoff is based on time, assuming we're not talking about flips. Their payoff is based on time. The more time in the deal, the better. All of their work, or most of their work, is front loaded, bringing the property up to standards, getting it rented out, right, stabilizing, etc. So to get paid off, they need the cash flow over those 3, 4, 5 years and the mortgage pay down. The money person is in it for a bunch of money, and they might prefer to get out early if they need the cash for something else, or if they're not seeing quite the same return that they were expecting, et cetera, et cetera. That needs to be treated a little bit differently, in my view, if I'm representing the active partner, and which mostly I do, because it puts a disproportionate disadvantage on the active partner. And so I generally like to build in the option to exit early, but with a cost, where if a partner wants out, they've got to give up a portion of their share to the other side, so that and the farther along into the joint venture, the less percent is given up, because this way we're sort of matching the disadvantage, right? We're balancing it
Yep.
out.
that makes sense. What else can we pick apart here, with joint venture?
Well, let's talk about selecting partners, right? So money is a commodity, right? Your $5 bill is worth the same as mine. And so what that means is a money person. Have you read Money People Deal by Stephen
I
Arney?
have not.
Okay, great book. Really sets out that there's three components to any deal: money, the people involved, and the actual deal itself, right? The opportunity. And one of the things Stefan talks about is being wary of each component, right? A deal is a deal if it pencils out under conservative circumstances. The people involved generally have to be good people. They have to be skilled in some sense, and they've got to know people, etc. If you don't know enough, you've got to have a mentor to be able to help you, because especially as an active partner, you are a steward of someone else's money. And then the money piece. And the money is obviously important, but like I said earlier, your $5 bill is just as worth just as much as mine. And so what that means for landlords out there is if you are partnering with someone with money, then you need to pick the right partner. What does that mean? Well, number one, not working with someone who's going to invest every last cent they have. That is a person who has not crested the ability to do something at the scale that you're doing, and they need to scale down. They need to be able to afford to lose it. And putting up your entire life savings on one project means you cannot afford to lose that. Right. So you want to be working with someone who can afford to lose, because that is a possibility. It's rare, but as you just said, $14 billion is exiting the market in valuations. And so it's so important to make sure that you're working with the right person. If you're a money person and you're trying to find an operator, you know, I think there are two classes of people. There are people who can show you a track record, and people who are getting started and don't really know what they're doing. And I generally encourage people, if you're partnering with someone who's just getting started in real estate, that's okay as long as they have a mentor behind them that can show a track record, help them make decisions, help them be good stewards of money. We all started somewhere. I remember my first real estate project. You probably remember yours. And if you're going to partner with someone who has very little experience, that's okay. But you need to make sure that they have some guidance behind them, because that's not your job. If you were given the guidance, you might as well just do the project yourself.
Not like she's, around today, but we'll give her a nice little plug, Monica Janiks and, RPI, right? We work with them to help the understanding and the guidance for your different projects. Specifically, the BRRRR is something that, her group teaches the most and, works with people the most on. But anyways, exactly that, having somebody that knows exactly what they're doing, so they can guide you, through the entire process, especially if you're new to the game.
Yeah, that's so good. And Monica and Vaughn know exactly what they're doing and have been doing it a long time. So great people to have in the background, and their students, might be new as well. But that doesn't mean they're not going to be good operators.
Yeah. We all start somewhere, right?
That's right. That's
We
absolutely
all
right.
start somewhere. Um, that's been a great conversation in my mind. If there's anything else that you want to throw out there to the people before we say goodbye for today, or what are your thoughts there?
What I encourage people to do is if you're getting into real estate or you've been in it and you want to keep going, um, talk to other people. If you're going to partner with someone, have a few conversations with them about things other than real estate before you partner with them. Get good legal counsel, right? No one really wants to pay a lawyer, but but it's the cheapest insurance policy you can buy, and that few $100 or a couple $1,000 is the best money you can spend, because the number of people that show up and spend tens of thousands of dollars on litigation because they don't have a well drafted contract would shock you. And you can avoid a lot of that. I didn't really get into this, but one of the things that I tell people as we're preparing to draft a joint venture contract is we need to create a pathway to all results. Because if we can create a path to every single possible result, a contractual path, then there's never any ambiguity and we can't really disagree. If this happens, this is the result, right? This is the process we go through. This is the result. Okay. Well, if it happens, then we just go through it. And there's no arguing. There's no anything. And once a problem shows up, it's far too late to agree on something because that's when we go to
Yeah,
litigation.
and emotion gets involved
So,
in everything, right? So you
oh,
start.
right. That's the ultimate point. Is if you have it drafted, you can be as emotional as you want, but it doesn't matter because the writing's there and you signed it.
Well, I think that's a lot of great advice there. You did mention getting to talk to people and getting in and around the same right of people. I'm going to use that opportunity to plug the Investor Summit as well, where we have a whole bunch of different types of investors and educators, speakers like Shawn, who will be there as well to educate and inform landlords, investors. We're in the fall, more details to come, but the next one is September 25th out in Markham. But yeah, Shawn, thanks so much for joining us today. It's a pleasure to chat with you. I hope everybody took some notes and understood. And all of Shawn's contact information and will pop up throughout that episode. It'll be there below, so you can click on him or connect with him. And if you can't get to him, get to me, and I'll get you to Shawn because he's a great person to have on your side. That's for sure. Thanks so much, Shawn.
Thanks for having me, Kevin.
Bye for now, folks. We'll see you again.
Please remember, while we are professionals, this podcast is for informational and entertainment purposes only. The advice shared may not apply to your unique situation. Always seek personalized advice from a qualified professional before making any investment decisions.
Hey, everybody. Thanks so much for joining us this week. I hope you enjoyed the episode. If you're finding it informative and useful, make sure to like, subscribe, share with a friend so that we can keep getting the information out there to Ontario landlords. And keep on joining us. We'll see you next time.